Hey, everybody. Can y'all hear me?
Yes.
Okay, great. So there's only one student here today, or well, there were two that came in today. So I'm just going to go ahead and sit in front of my screen and instead of doing a synchronous thing where I'm trying to write on the board, just going to do the whole thing on Zoom today. So I hope you guys fared out fairly well, and none of you are really were hurt too badly from the storm. I know we're all trying to just get back in the swing of things, so I wanted to just kind of ease back into the semester. So what let me share my screen and just go over what's going on here with the class. So this week is optional to Zoom. Starting next Monday, there's a face-to-face requirement. So y'all are expected to be back in the classroom face-to-face starting next Monday. If you have extenuating circumstances where you've had to move out of state or out of town, just let me know and we can work something out. And forgive me if you've already emailed me about it, but just you need to email me again and we can work something out. But the expectation that the president wants is for everyone to return face-to-face unless there's extenuating circumstances. So what they did was they got rid of the 2 fall breaks, and they have us going to school during Thanksgiving week, Monday, Tuesday, and Wednesday. And then they extended the semester by 1 week. So that basically gave us like almost a month. That made up for all the time that was lost. So I was able to go in and push all the due dates back. So it's not like anything's going to be compressed or anything. If anything, it's giving you more time with this first section. All right, so let me, here's that's the homework. Okay, so, in case you forgot, or some of you were confused about where the homework is, the assignments are all in the back of the book, as you know, and this is in Moodle. All of your homework assignments are up on Moodle here. All right, and then I revised the course content, which is right here on Moodle. Also, the drop date has been extended. The new drop date is November 30th. But here's the revised schedule. Okay, so you see here, we just basically, this was our last class, well, around the 23rd or so. I guess it was the next week, but anyway, I just kind of skipped over to today. All right, so what we're going to do today is I'm going to go in, we're going to look at these homework assignments because some of you are having trouble doing these homework assignments. And so we're going to go through chapter 3 and chapter 4, and I'm going to give you some hints on how to do those homework assignments because they're due on Wednesday. So before class on Wednesday, you either need to come into class physically to turn in the assignment or upload it. Regardless, you can turn it in physically or you can upload it to Moodle. So there's the turn in portals there in Moodle where you can turn them in. If you don't have internet, and another way to turn in the homework is just to do the homework by hand or what have you, or on your computer without internet. Take a screenshot and then, or take pictures of your homework and just text it to me. That's fine. My cell number is 985-640-2616. So 3 ways: turn your homework in person, upload it on the portal, or you can take screenshots, take pictures and text it to me. So on Wednesday, chapter 3 and chapter 4 is due. And so we'll be going over those in class, and I'll give you the solutions. We'll work them out on Wednesday. And then also you have this take-home exam, this take-home quiz. So I converted the quiz to a take-home quiz. That is already up on Moodle, and it is covering chapters 3 and 4, and that's going to be due in class before class on Wednesday. So again, turn it in through the portal, bring it in class, or take pictures of it and text it to me. So when you go into Moodle, well, anyway, let me just talk about this some more. All right, so that's what we're going to do this week is go over chapters 3 and 4 this week again, and go over the homework on Wednesday. Then on Monday, the 27th, we'll be reviewing for the exam. So the exam is all multiple choice. It's problems and topics, conceptual questions and problems. Some of these multiple choice questions can be a bit confusing, so you really have to know the material. So I'm going to write up a study guide and post the study guide. Really, the study guide is going to have a lot of hints on it. So you really need to look at that study guide and know that material really well, so you don't get confused on these multiple choice questions. I'll spend all of Monday, the 27th, reviewing the exam with you. Okay, so then the exam is going to be on the 29th, Wednesday, the 29th. So a week from Wednesday, that's your first exam. So this is what you really need to concentrate on now, is just chapters 1, 3, and 4 and studying for the exam. And I will have that study guide posted by tomorrow evening. I'll make sure that I definitely get that done tomorrow, by Tuesday evening. All right, so that's the new schedule. So anyway, just looking forward here, we have the second exam, which is only on chapter 5, is going to be on the 13th of October. Then we're going to cover the next 4 chapters. The third exam is going to be on the 17th of November. And then the 4th exam is on December 6th. That's a Monday. That Wednesday is the last day of class. We'll review for the final. And then the final exam is pushed back a week. It's going to be on December 14th, Tuesday, December 14th. So does anyone have any questions about the new due dates or anything? Okay. Are any of you going to be unable to start attending next week? So you all are gonna, okay, so that's good then. You all can start attending next week. Okay, so let me get out of this and go into Moodle here. All right, so here's, so since we're, in order to kind of review, since, you probably haven't been thinking about this class for the last month. And so to kind of get back in the swing of things and review, I would strongly suggest that you go over this chapter 3 synopsis. This is one of my lectures from last semester covering chapter 3. So I would definitely go over that. You can also look at these. These are tutorials on YouTube if you want to get some extra, extra help on these topics. And then here's the turn-in portal for chapter 3. But definitely look at this synopsis to kind of give you a refresher about chapter 3. And then for chapter 4, the same thing. This is one of my old lectures, so definitely go over that to review. And here's your turn-in portal. Okay, here's the take-home quiz. So what you're going to do is download this take-home quiz, and hang on. It's just a Word document, and you're going to complete this take-home quiz and then upload it to the turn-in portal. So it's not an online quiz where you go online and it's a multiple choice thing. This is the actual quiz, just like I would pass out in class. So you're going to complete this quiz and then upload it to the Turn-In portal or turn it in class. So what's going on here is this is basically a bunch of accounts. This is a mixed up income statement / balance sheet. So there's information in here that would be in a balance sheet. There's also information in here that would be in an income statement. So using this information, you're to create a balance sheet and an income statement using this information. Some of the information is for the balance sheet, some's for the income statement. Some of it may not be for either. So be careful of some erroneous information in there that would not be in either one. All right, and then once you do that, of course, you can hit the return bar and give yourself some more space here. Then you answer these questions. So you're going to create a balance sheet and income statement for number one. For number two, it's just asking you, what is the amount of the total common equity? All right, and then for the rest of this, you're supposed to calculate these ratios and explain the meaning of the ratios. So here's the current ratio, here's the quick ratio, debt ratio, debt to total capital, and then the times interest earned. So calculate those ratios and explain the meaning. And you can use the book, since it's a take home. You can use the book to get the formulas and so forth. So the idea of this is to allow you an ample time to really understand this material. So you all should get a pretty good grade on this, since it's a take home. So that's the quiz. That's going to be due on Wednesday in addition to the homework. Any questions? Okay. All right, so let's go, let's take a look at, if you have your book with you, or if you're able to pull up the questions. Let's go ahead and look at these homework problems. So let me see here. See, I don't have an online version of the book, so I'm trying to figure out what to do here.
My textbook over here does.
That's okay. I'm going to stop sharing the screen. Well, I know what I'll do. I'll pull up a Word document so I can write on the screen here. Let's see. Hang on a second. Okay. So let's take a look at the chapter 3 homework. And as we're going through this, I'll give you some hints, because some of these problems can be confusing. Okay, so it's questions 1 through 8. And so you can go ahead and try to work the questions on your own. Let's look at the problems. So the problems are 1, 2, 4, 5, 6, 5, 7, 9, and 14 A and B. Okay, so let's go through these problems. So for problem 1, let me pull up problem 1 here. Okay, so with problem 1, you have this mixed up balance sheet, or basically they want you to recreate a balance sheet. So this can be a little bit confusing on how to get started. But I'm going to just get you started on this, and then you can answer the questions. So instead of trying to, for problem 1, instead of trying to answer questions A through H right off the bat, the best thing to do is to create the balance sheet first. So let's read, I'm going to read the problem out loud, and then tell you how, basically tell you how you can create this balance sheet. All right, so it says Dallas and Associates, the assets of Dallas and Associates consists entirely of current assets and net plant and equipment. The firm has no excess cash. Okay, so let's look, this is 3-1. And so let's start to create this balance sheet based on what they're telling us. So they're telling us that their entire balance sheet on the asset side consists of current assets, net plant and equipment, and that's it. So we'll put total assets here. All right, so that's the first sentence. They told us that the assets consist only of current assets, net plant and equipment, and that's it. So those are our total assets. All right, and then they say that the firm has total assets of 2.5 million and net plant and equipment of 2 million. Okay, so the total assets are 2.5 million. So the first thing we can do then is put the 2.5 million down here in the total assets. So if the total assets are 2.5 million, what does that tell you about the liabilities and owner's equity?
That what has to equal that amount.
Right, it's got to equal that amount, right? So if our total assets are 2.5 million, then our total liabilities and owner's equity is also going to be 2.5 million. Okay, so now we have the totals of the assets and the liabilities and owner's equity for the balance sheet. We know what these have to equal. Okay, then they tell us that the firm has total assets of, has net plant and equipment of 2 million. So the net plant and equipment is 2 million. Okay, so now we know everything about the left side of the balance sheet, because they told us that these are the only 3 items. And if the net plant and equipment is 2 million, then the current assets obviously has to be 500,000. Okay, so we've done the whole left side right there. All right, so now let's do the right side. Okay, so they told us that the notes payable are 150,000. So let's come up here. And remember, the notes payable is a current liability. That is, are you seeing my screen? Okay. So notes payable, 150,000. Okay, we're going to have current liabilities here. And then we're going to have long-term debt. And they tell us, the next sentence, they're telling us that the long-term debt is 750,000. Okay. The total common equity is 1.5 million. Okay, so let's see what else here. the firm does have accounts payable and accruals on its balance sheet. All right, so we have to put that at the top. We don't know what that number is, this accounts payable and accruals. Okay, so what we know now is that the total liabilities and owner's equity is 2.5 million. The total common equity is 1.5 million. The long-term debt is 750,000. And the notes payable is 150. And then the only other thing that they would have on the right-hand side is their accounts payable and accruals. And they've told us that they have this, but they didn't break it down for us. So basically, this is the only missing number. So we just have to take the 2.5 million and subtract these numbers out to get this plug number, if you will. And so if you take 2.5 million, subtract 1.5 million, that gives us $1 million. And if you subtract 750 and 150, that gives us $100,000. So our last number in this puzzle, our last piece of the puzzle, if you will, is 100,000 in accounts payable and accruals. So this makes the total liabilities. Let me underline this here. The total liabilities then is going to be 250,000. Right. So we have created the balance sheet now. We have, from the information that they've given us, current assets, 500,000, plant and equipment, 2 million, total assets, 2.5 million, accounts payable and accruals, 100,000, notes payable, 150, gives us our current liabilities of 250,000, the long-term debt, 750,000. So our current liabilities plus our long-term debt would be this number. If we wanted to do a subtotal, would be $1 million. And then the total common equity that they gave us is, remember, the total common equity is your common stock outstanding and your retained earnings. So they just told us what the total number was. So the common equity is 1.5 million, which brings us to the 2.5 million. Okay, so this is what your balance sheet should look like. So now you can answer all these questions. So I'm going to leave that to you. Now that I've given you some hints to show you how to create the balance sheet, then you can answer these questions A through H.
We have to show what you bring the balance sheet and the homework.
What do
Like,
you-
my meaning is in the homework or answer questions, we have to create a balance sheet in order to show how we found it.
No, you don't have to. If you don't just answer the questions, it's fine. If you don't have, the question was, do you have to show your work and create this balance sheet and your homework? You don't have to. You can just go ahead and answer the questions if you want to. It makes more sense, though, if you want to include this, to do so. Okay, so go ahead and answer those questions. Do you have any questions? Those of you who are zooming in on problem 1? Okay. All right, then let's move on to problem 2. Okay, so in problem 2, it says that this company reported 15 million in net income. Its earnings before interest and taxes was 20 million. Tax rate is 25%. What is the interest expense? Okay, so this one, what you need to do is you need to create a partial income statement, and then you have to work backwards from that. All right, so let's see how you would set that up. Hang on 1 second. Okay, so let's create a partial income statement to make it easy. So it says that from the information given, that their earnings before interest and taxes is 20.8 million. So their EBIT is 20,800,000. And then remember from the interest expense, after below your EBIT, you would subtract out the interest, which we don't know. So there's our interest. All right, and then below that, we would have our earnings before taxes. And below that, we have our taxes. And then we have our net income. All right, so what do we know now? We know that the EBIT is 2,800,000. The tax rate is 25%. We know that the net income is 15 million. Okay, so here's the hint that they've given you in the textbook in that problem. So if you take the taxes, excuse me, if you take the net income, in other words, the EBIT times the taxes is going to give us the net income once you subtract that out. So if you take the net income and you divide that by 1 minus the tax rate, that will give us our EBT. So in other words, let me write this down for you. So the earnings before taxes is going to equal the net income divided by 1 minus the tax rate. So in other words, what you have to do to solve this problem is you take the 15 million and you divide that by 0.25. I'm sorry, 0.75, 1 minus 0.25. Okay, so 15 million divided by 1 minus the tax rate is 15 million divided by 0.75, and that is 20 million. Right? It doesn't matter what the taxes are. Now all we know is now we can solve the problem because we know our earnings before taxes is 20 million. Our earnings before interest and taxes is 2.8 million. Therefore, the interest expense has to be 800,000. And so that's how you solve that problem. And your answer is 800,000 for number 2. All right, so this was a little confusing as well, but that's how you solve it. Any questions on number 2? Okay, let's go to 4 then. All right, so problem 4 is asking about the statement of stockholders' equity. All right, so it says here that in the most recent financial statements, Nestle reported 75 million of net income, 825 million in retained earnings. The previous retained earnings were 784 million. How much in dividends were paid to the shareholders during this year? Assume that all dividends declared were actually paid. Okay, so you need to know this formula and able to solve this problem. So let's see here. So the retained earnings, here's the formula. The retained earnings for the current year equals the retained earnings of the prior year plus the net income, the current year net income. I'm going to say net income minus dividends paid. Okay, so in other words, if you want to know what your current retained earnings are going to be, or what your retained earnings for the current year are, you look at the retained earnings from the prior year, you add any current year net income, and then you subtract any dividends that were paid. So this is the formula for it, to calculate the retained earnings for the current year. So just to repeat, it's your prior year, the year before retained earnings, plus the net income for this year, minus any dividends that were paid. In this question, they're giving you the both retained earnings, and they're giving you the net income, and they're asking you to solve the dividends. So you're just solving for the dividends paid. Any questions on that? Okay, so that's how you do number 4. All right, and then number 5. Take a look at 5. Okay, this is the market value added. This company has 900 million of common equity on its balance sheet. Its stock price per share is $80, and it has a market value added of 50 million. How many common shares are outstanding? Okay, so the formula for the market value added, MVA, equals, where's that? Okay, it's the price of the stock.
The market value of the stock times number of shares.
Yeah,
Then take that and subtract from it the book value.
right. Okay, so the MVA is the price of the current price of the stock times the number of shares outstanding, and you subtract the book value of the common equity. I was just looking at a message to see if, no, I can't get this off the screen. Hang on. Okay, so here's the formula, and they're asking you to calculate the number of shares outstanding. So you have to just algebraically solve for this. You're solving for the number of shares outstanding. All right, so now that you have the formula here, try to work that out. We'll go over the answers on Wednesday. Okay, and then number 7. Is the economic value added. So if a company has operating income of 3,500,000, they're in the 25% tax rate. Its total invested capital is 20 million. Its after-tax percentage cost of capital is 8%. What is the firm's economic value added? All right, so for the economic value added, that is this formula. The EVA equals their earnings before interest and taxes, EBIT, times EBIT times 1 minus the tax rate minus the total invested capital times the after-tax cost of capital. Okay, so if you think about this problem, what they're actually asking, they're asking how much value has been added to the firm. And so this is the company's earnings before interest and taxes times 1 minus the tax rate. So these are their earnings, their after-tax earnings. This is what they spent. This is how much they invested in, how much they purchased in capital. And this is multiplied by how much they had to pay their investors. So it's their cost of capital times the cost of capital, the total capital invested times the cost of capital. You subtract that from their earnings before interest and taxes, and the difference is the total economic value added. So that's how you calculate this. So go ahead and try to work that on your own now that you have that formula. Okay. And then the next problem is number 9. Okay, so for number 9, that's just asking a question. It's a multiple choice question about some balance sheet information. So it says, which of the following actions are most likely to directly increase cash as shown on your firm's balance sheet? And so just look at those, think about those 4, and just discuss which of the following will increase cash on the balance sheet. Okay, and then 14A and B was the last question in chapter 3. That's dealing with free cash flows. Okay, so let's take a look at A. All right, so remember, free cash flows are the cash flows that are available to investors after the company has spent all the money that they're going to spend on plant and equipment. Basically, after they've made all their capital investments, then the free cash flows are what's left over. So here's the balance sheet and an income statement on 314. And the first question is, what is the company's net operating working capital for 2020 and 2021? Assume that all cash is excess cash, i.e. this cash is not needed for operating purposes. All right, so the first thing, so for A, you're going to calculate the net operating working capital, which is what you need. You need that number to calculate the free cash flow for part B. All right, so let's see here. To get the net operating working capital, one second.
In the book, it said that it was current assets minus excess cash, and then from that subtract current liabilities minus notes payable.
Right. Okay, so yeah, they get a little confusing with this excess cash. So let's I'm going to write down this formula. So the net operating working capital is going to equal basically it's operating current assets minus operating current liabilities. And by operating current liabilities, it means you do not subtract out the notes payable. You don't include the notes payable because those are not operating current liabilities. Those are financing current liabilities. So this is the way the formula works then. This is how the formula would look. It's going to be current assets, total current assets minus excess cash minus current liabilities. It's total. Minus notes payable. Okay, so that's your formula to calculate the net operating working capital. That should be a C. That's part A. Okay, and then for part B, they're asking you to calculate the free cash flow. All right, so here's the formula for the free cash flow. The free cash flow equals the earnings before interest and taxes. Looking for a bracket. Okay, it's going to be EBIT times 1 minus the tax rate plus depreciation minus capital expenditures plus the change. That's a delta sign. I'm just going to put change. I don't know how to get the delta on the computer. Change in the net operating working capital.
So it's change.
Yeah, it's the change. Okay. So for A, you're going to have to find the net operating working capital for both years.
What does a capital expenditure mean?
Okay, and then so let me repeat this. So for A, you're going to have two numbers. You have to calculate the net operating working capital for 2020 and for 2021. All right, so which is that's directly from the balance sheet. Okay, then for B to find the free cash flows, you go to the income statement, look at the EBIT, and that is 44,000. So you're going to take the EBIT times 1 minus the tax rate. And they'll tell you in here what tax rate they're in. Let's see where the tax rate is. The taxes are 25%, plus the depreciation. Depreciation is on the income statement. The capital expenditures, that's the change in the plant and equipment on the balance sheet. Okay, so you're going to come back to the balance sheet and look at your plant and equipment. You see the net plant and equipment there is the net plant and equipment is in 2020 is 46,000. The net plant and equipment in 2021 is 48,000. So it's the change in the net plant and equipment plus depreciation. So let me, hang on, let me double check that number.
So we're taking previous year PPE, subtracting it from the current year or whatever. And then or taking the current year's PPE, subtracting from the previous year, and then subtracting from that depreciation.
No. You mean to find the capital expenditures?
Yeah.
No. Okay, so the capital expenditures, let me back up. The capital expenditures are the change in, it's actually the change in the gross plant and equipment. But if you notice that in that income statement, they don't give us the gross number. So we have to add back depreciation. So it's the change in the net plant and equipment plus depreciation. So if you go back, take a look at the balance sheet. They had their net plant and equipment was 46,000 in 2020, and it was 48,000 in 2021. So they spent, the net that they spent was $2,000, but they were able to depreciate 6,000. So you got to add back depreciation. So the change in capital expenditures is $8,000.
Okay, so the change in PPE plus depreciation.
Yes, yeah. So it's the change in the net PPE. Capital expenditures is the change in the net PPE plus depreciation. So right here, this is the change in your net PPE plus depreciation. So this number should be $6,000 right here. And then this is your change in your net operating working capital. That's the difference between your two numbers that you're going to get from part A. Any questions? Okay, so go ahead. Now you have the formula and I've explained how to calculate this. So go ahead and do those calculations. We'll go over that on Wednesday. All right, so this is chapter 3. Now let's go to chapter 4. Okay, so the problems for chapter 4 are 1, 3, 5, and 23. These are dealing with ratios. So let's go to chapter 4, and 23 is the long problem. So the main thing to concentrate on with chapter 4 is number 23 with all those ratios. So let's go skip to 24. One, 3, 5, and 23. Okay, so number 4 is asking it says the Baxley brothers had a day sales outstanding ratio of 23 days. Its annual sales are $3,650,000. What is its accounts receivable? All right, so they're not asking you for the days sales outstanding. They're telling you what that ratio is, and they're asking you to calculate a portion of that ratio. So let's take a look at what the DSO ratio is, what the formula is. So the DSO, days sales outstanding, equals the accounts receivable. I'll write this out for you so you know. Divided by sales over 365 days. All right, so they've given us the DSO. The DSO is 23, and they've given us that you have the sales, and you just have to solve for accounts receivable algebraically. So you're just solving for the accounts receivable for that one. All right, and then for problem 3, 4.3. Oh, that's a DuPont question. I think I told you we were going to skip that. Did I not say we were going to skip the DuPont analysis? Do you remember that?
I don't think so.
I did not say that. Let's see here. Yeah, we can skip 3. We can skip that. All right. Okay, number 5, the price earnings ratio. Okay, let's take a look at that. So 4.5 is the PE ratio. The PE ratio equals the price per share, the price of the stock, price per share, divided by earnings per share. Okay, so in this case, let's see, a company has earnings per share of $2.40. book value per share of 21.84 and a market to book ratio of 2.7. What is the PE ratio? Okay, so this is a little confusing. We have to figure out what the number of shares outstanding is. They gave us the earnings per share, but we have to figure, and they gave us let's see. They gave us the book value per share. So we have to figure out, we've got to use the book to market ratio to get another number before we can calculate the PE ratio. So this one's a little bit confusing. Let me show you how to get started with this one. Okay, so we have to figure out the price in order to figure, we know what the earnings per share is. They told us the earnings per share is $2.40. And we need to figure out the price per share. In order to get the price per share, we can use that market to book ratio. So the market to book ratio, market to book is going to equal the book value. Let's see, it's going to equal the price divided by the book value per share. All right, so what we can do there, they gave us the market to book is 2.7. So 2.7 times is going to equal price per share divided by the book value per share, which they gave us to be 21.84. Right, so using algebra, you can figure out what the price is right here, the price per share using this formula. This is our market to book formula. So once you figure out the price per share, then you plug that number in here and you get the PE ratio. So that's how you solve for number 5. Okay, now as I mentioned, the most important problem here is 23. So let's look at 423. That's just a bunch of the ratios. And so you should, when you're doing 23, go ahead and calculate these ratios. The formulas are in the book, at the end of the chapter. Towards the end of the chapter, they have all the formulas. So let me just tell you what some of these formulas are. So the first, so they want you to calculate these ratios for this Berry company. All right, so the first ratio is the current ratio. The current ratio is current assets divided by current liabilities. So if you go look at the book here, current assets are 655,000, and current liabilities are 330,000. So you're going to take the 655 divided by 330, current assets divided by current liabilities. And then you're going to compare that with the industry average to see how they're doing. Okay, the quick ratio is when you subtract out the inventories. So the quick ratio is current assets minus inventories divided by current liabilities. That's the second one. The third one, day sales outstanding, that is accounts receivable divided by sales over 365. All right, so you go to the income statement, and you go to the balance sheet, to the asset side, and you get their accounts receivable, their receivables, 336,000. So for the day sales outstanding, you're going to divide accounts receivable, 336,000, divided by sales, Sales is on the income statement. Sales is 1,607,500 divided by 365. And then for the inventory turnover, you're going to take the cost of goods sold divided by inventories. And the cost of goods sold is that the subtotal on the income statement down here under all these costs of goods sold. It's 1,351,000. Divide that by the inventories, right? And then the total asset turnover, that's sales divided by total assets. Profit margin, net income divided by sales. Okay, return on assets, net income divided by total assets. Return on equity, net income divided by common equity. Okay, so what is common equity? Common equity, you go back to the balance sheet and the common equity, well, they give us they actually gave us the total there. The common equity is 361,000. That's the common stock outstanding plus the retained earnings. They combine that. So that's easy. So return on equity, net income divided by common equity. Okay, and then this return on invested capital, that's the earnings before interest and taxes divided by the total invested capital. All right, so that is, so you take the EBIT and you multiply that by, that's 70,000. You take the EBIT of 70,000 and you divide that by 1 minus the tax rate, which is 0.75. And then you divide that by their total invested capital. And that number is 701,500. So just to repeat this, ROIC, it's the EBIT times 1 minus the tax rate divided by the total invested capital, which is 701,500. And let's see, off the top of my head, I forgot how they did that. Let's see, the total invested capital is the common equity. Hang on a second.
Common equity and the payables, right?
I think it's plus the excess cash or something. I forgot how they got to that number. I'm gonna have to go back and look at the book because this is kind of a new ratio. I'm not real familiar with that one, and I always forget how they came up with the total invested capital. But I will. Don't worry.
They add long-term debt.
Yeah, they add the long-term debt and the common equity, but there's something else.
I did the notes payable.
Oh, okay, wait a second, but that still doesn't get you to their number, which is 701,500.
That does.
It does? Okay, maybe hang on. 256, 200, wait, 256, 500 plus 361 plus 84. Yeah, you're right. I'm sorry. Yeah, you're right. Okay, so let me write this down for you. For the ROIC equals, because they don't really explain this well in the book, equals EBIT times 1 minus the tax rate divided by total invested capital. All right, and total invested capital is long-term debt plus common equity plus notes payable. So long-term debt plus common equity plus notes payable. That's how you get your total invested capital. Okay, so that's how you get that ROIC ratio. All right, and then back to the times interest earned, the next one, that's earnings, the earnings before interest and taxes divided by the interest payments. That's from the income statement. And then the debt to capital ratio is total debt divided by total invested capital. So again, the total invested capital, it's your notes payable plus your long-term debt plus your common equity. And that's your debt to capital ratio. Okay, and then the market to book ratio, it's the price of the stock divided by the book value. The price earnings, the PE ratio, that's the price of the stock divided by the earnings per share, which is, and the earnings per share is net income divided by the number of shares outstanding. So you got to take the net income, divide that by the number of shares outstanding. Well, I'm sorry, they give, in this problem, they gave you the earnings per share already. If you were to have to calculate that, you take the net income divided by the number of shares outstanding, but they've given you the earnings per share right there underneath at the bottom of the income statement. So PE ratio, price divided by earnings per share. And then don't worry about that last one, the EV to the enterprise, the EV to EBITDA, that's the enterprise value divided by EBITDA. That one you can skip. Okay, so then after you do all these ratios, just to analyze the ratios and just answer these questions, answer B, C, and D to kind of analyze those ratios. So hopefully this is enough to information to answer any questions or confusion you might have had about the two homework assignments. Does anyone have any questions? Yes.
This is more about just general question, but what the total debt, that would just be all the payables at all the total liability. In other words, the total liability, right?
Well, no, the question is total debt. I'm sorry, the total debt.
Like that for the debt total,
the debt.
Capital ratio.
No, because you don't include the accruals or the notes payable. I'm sorry, you don't include the accruals or the accounts payable. It's just your financing. So it's your debt plus your equity. So it's the common equity plus the long-term debt plus the notes payable. Okay.
Don't you mean total invested capital for that one?
Yeah, for total invested capital is the common equity plus the long-term debt plus the notes payable.
Total debt is.
Oh, I'm sorry, total debt is the notes payable. I'm sorry, total debt is your current liabilities plus your long-term debt.
Yeah, that's what I thought.
Yeah.
So sorry for confusion.
Yeah, so if you do, yeah, the total debt is your current liabilities plus your long-term debt.
Okay.
Okay. Okay, does anyone have any does anyone else have questions? All right. I think we're almost out of time here. Okay, so go ahead and for Wednesday, go ahead and complete the homework assignment. Complete the homework assignment for Wednesday and complete the take-home quiz. And we will spend Wednesday going over those. And come to class if you can, if you're able to. And for those of you who can't, we'll do Zoom again on Wednesday. See if there's anything in the chat room. Okay, if no one has any questions, I'm going to sign off then. And also, if you want to bring an article in for a current event, you can share it through Zoom or in class. That's fine as well. Okay, take care, everybody. And I hope to see you in person, if not Wednesday, the following Monday. Goodbye.